Well, welcome back to Finance Uncut. On today's episode, we explore the claim from legendary investor Jim Rogers that silver is the most undervalued asset in the world.
Jim, we always love getting advice from you. Last time we spoke, you liked Indian tourism, agriculture. Of course, you like gold. Has anything changed for you or new sectors of opportunity that have opened up here for you?
Well, silver's better. Silver's still cheaper. I mean, I own both. I own both, and I will be buying more of both. But not now. I'm waiting for the correction, if there's a correction. But I will buy silver, and I'll buy more silver. Silver's down 45% from its all-time high, Daniela. Gold is near its all-time high. Stocks in many countries are near their all-time high.
There's a lot of talk of, triple-digit silver, $100 silver, especially with initiatives like the Green New Deal. Do you see that scenario playing out, Jim?
Well, I do know that the world is moving more and more towards electric cars, whether we like it or not. And electric cars use, for instance, 5 times as much copper as they use in a regular car. So there's going to be more demand, and silver, of course, is used a lot in many of the new applications. Solar energy uses silver. So I'm optimistic about many commodities going forward. I'm still buying agriculture. I see the cheapest area of the cheapest asset class in the world. I mean, bonds are in a bubble. Property in many cities is in a bubble. Stocks are near all-time highs. So commodities are still the cheapest asset class I know.
And I know one good rule of thumb you taught me, Jim, personally, many, many years ago, is you like to buy gold under 1,000, under 900 preferably. What would be the mark for silver then? Under what price?
Well, yes, I certainly would like to buy silver under 10. But Danielle, I don't think that's going to happen in my lifetime again. No, I don't have a price for gold or silver right now. I let the market usually tell me what to do. When I like despair, when I see despair or people giving up on something, then I will probably buy more silver, more gold. But there's certainly not despair in either of those markets right now.
The price of a commodity will never go to zero. Whenever you invest in commodities futures, you're not buying a piece of paper that says you own an intangible piece of company that can go bankrupt. Jim Rogers. So I've shared this graph in previous videos looking at the global silver industrial demand and physical and ETF investment demand. And we can see that the investment demand is at all-time highs at the moment and continuing to increase. However, we also know that industrial demand, as we continue to electrify the economy and move to this green energy revolution that we're moving to, the industrial demand for silver is only going to continue to go up. And you can see that the five of the key commodity inputs into the manufacturing process for renewables, well, you can see silver is one of the most important key commodities into that. So once again, just the fundamental demand as we change the economy, as we move away from coal and gas and other oil and other energy to this new green push. I've shared in previous videos what my opinion of that is and whatever, and the greenwash. And in this video, we're not discussing whether that's a good thing or a bad thing. It's happening. So sometimes we need to invest on what's actually happening and what's going to happen, not what we want to happen. Now, we know that silver production peaked in 2016 and just goes down from here. And I've shared this in other videos as well. So, we've got the fundamentals here, supply going down while demand going up. It's really economics 101 as to what that means for the price of silver. The biggest public fallacy is that the market is always right. Market is nearly always wrong. I can assure you of that, Jim Rogers. So when we have a look at gold versus real interest rates, or the 5-year TIPS yield inverted, you can see that at the moment, gold is undervalued according to this, and you can see that it tracks very, very nicely. Gold should be around $2,000 or just over $2,000 an ounce, just based on this. And therefore, if you look at the gold-silver ratio, and we'll have a look at that shortly, that the price of silver should be increased as well. And that's just looking at the 5-year TIPS yield inverted. Here we've got the gold price in blue and the 10-year Treasury in red, and you can see when the 10-year yield bottomed on August 4th and has continued to rise, that was around the same time that the price of gold peaked and started heading down. Now, the market has got this wrong. The market is obviously factoring in inflation, and they're thinking that that the Fed, that central banks are going to do something about this and lift interest rates. And so interest rates are rising, gold price is coming down. The problem is with our debt loads at all levels, whether we're looking at household, corporate, or government debt, central banks cannot allow interest rates to rise too much, or the whole debt bubble blows. And we have the greatest deflationary depression you've ever seen. It'll make the 1930s look like a cakewalk. So you look at Russell Napier and many other legends in the macro game, so that we're looking at financial repression. We're looking at where inflation is above, CPI is running above the 10-year yield. So those that are owning bonds are actually are going to lose out. That central banks are going to cap yields, and we're probably getting close to where they're going to jump in and start capping yields. And what does that mean? Well, that means you get negative real rates. Negative real rates. And that is what drives gold and silver. So the market's wrong. The market's wrong. They think the Fed and the central banks are going to lift interest rates when inflation rears its ugly head. You all know that it's already here. We're seeing increases in just all of our cost of living, but it's yet to show up in the CPI numbers. However, we'll come to that in a sec. So here we've got the real yield. So the 10-year Treasury minus the 10-year inflation rate. And so you can see that the yields were negative and are still negative, but they're not as negative as they were. And this is what really drives the price of gold in most occasions. Now, there's some occasions where fear, when we there's times where there's just mass panic, mass fear, and gold does well no matter what real yields are doing. So once again, the market's got this wrong. We're going to see further negative real yields. I'm talking real yields. So that's the 10-year yield minus the inflation rate. Now, want to know where the inflation rate's headed, coming in from double line funds. So if you look at the real bond king, okay, not these self-appointed bond kings, I mean the real bond king, billionaire Jeff Gundlach. All right, this chart is from him. He is predicting by June this year that we're going to see CPI with at least a 3 in front of it, maybe with a 4 in front of it. All right, so at the moment, what's the CPI rate? 1.5%. What are Treasury yields now? Over 1.7%. So you can say right now we've got positive real yields. All right, and that trend has been there since August last year. And so that's been a headwind for gold and silver. However, when the CPI number comes out with a 3 or a 4 in front of it, and the yield on the 10-year is still around 1.7, maybe 1.8, you've now got a big negative real yield number. That is going to light a fire under the gold and silver price. Now, if you think that the Fed and other central banks will allow the 10-year to rise to 3 or 4% or 5%, well, I don't think so. I don't think so, because if that happens, this whole debt bubble blows up and we go into the biggest deflationary depression the world has ever seen. And the central banks have shown their hand. They ain't going to let that happen. So when are we going to see gold and silver really spike out? This is what I'm waiting for. The next CPI, the headline CPI number, which should come out around the middle of this year. This is what I think is going to drive that next big spike in the gold and silver price. Debasing your currency sometimes works in the short term. It has never worked in the long term and does not even usually work in the medium term. Lots of politicians like to do it because it's an easy way. Jim Rogers. You can look at any chart, the M2, which we know the Fed is now no longer tracking, or they are tracking, they're just not publishing it. So we can't see what the currency supply is. But anyone living under a rock, you don't even need to understand economics to understand the central banks, the government deficits, everything that they've been doing. This chart, I don't even need to elaborate. You can see it for what it is. So when we look back during the GFC, when the Fed added $1 trillion to its balance sheet in 1 year, we saw the price of silver spike 434%. The Fed has since added more, actually now. This chart's a little bit old, so they've actually added more than 3.2 trillion in 1 year. So where to for the silver price? I think it's going much, much higher. When we look at the silver to currency supply, so the US M2 currency supply, once again, I think we're still down at all-time lows. At all-time lows when measured against the M2. The City of London and Wall Street are not going to be great places to be in the next 2 or 3 decades. It's going to be the people who produce real goods in charge, the farmers and the miners. So when we look at the gold and silver miners versus free cash flow, I've shared this in previous videos. We're seeing free cash flow here, and you can see the price of gold and silver index. So from a free cash flow point of view, the underlying metals are undervalued from that perspective. When you look at the change in short and long-term borrowing versus free cash flow, so companies, gold and silver miners, have been paying off debt while producing so much free cash flow at the moment, and they are so undervalued, as you saw from that last chart. And I think it's a wonderful opportunity. Buy things when they're cheap, sell when they're high. In fact, it's interesting to see what gold and silver miners are now starting to do with their free cash flow. They are now buying back stock. So they're using this free cash flow to buy assets, so other miners off the juniors and explorers, but they're also buying back their own stock, paying out dividends, etc. The median total debt to asset ratio. Once again, you look at the balance sheet, and the gold and silver miners they've got the best balance sheet compared to all these other sectors. Okay, so they've been paying down debt like no tomorrow with their free cash flow, now buying back their own stock. Yet they're dirt cheap. I just wait until there is money lying in the corner, and all I have to do is go over there and pick it up. I do nothing in the meantime. Jim Rogers. This is a very important lesson. So many investors are so impatient that if the price of silver isn't skyrocketing in a week or in a month, then it's a rubbish investment. Remember, in previous videos I shared that I bought silver back in 2008, 2009, sold in 2011, turned those profits into 6 investment properties. Now, I got a little bit of luck involved in there as well. I came across a thing called wealth cycles. Go Google it, wealth cycles, where you move from asset class to asset class. This one was gold and silver and real estate. You can do it with stocks as well. And in 2011, I actually had a guy come to my office, a Scottish guy come to my office and present investment opportunities in the US to buy US property at the time. And I hadn't even thought about that at the time. And I did a little bit more research, came across a colleague of mine who had started buying property in the US. And so I thought, yep, let's do it. And I sold my silver. So I got out at the right time. Had that guy not come to my office, maybe I would have held silver longer, didn't sell in the $40 to $50 range where I sold at multiple times during that period. But the thing is, sometimes the best thing investors should do is just do nothing. Just do nothing. It's one of the best skills that you can do as an investor. One of the best skills that you can have is do nothing. Patience. Sometimes investing is boring. And I think this is a really good quote from Jim Rogers. When we look at the US private investment in mining exploration, now it's picked up, but it's been low for years. And so we've seen supply down. As I said, it peaked in 2016, but the investment into mining exploration hasn't been there. Now it's starting to pick up. We're starting to see juniors and explorers starting to put some money into this, and the big boys, accumulating some of these assets that are found, because sometimes these explorers don't have the capacity to raise the capital to turn into a mine, and so they sell their assets to a bigger player. Commodities to equities ratio. When we have a look at this, commodities to equities, once again, commodities are based on this chart at all-time lows. Commodities to GDP ratio, all-time lows. Once again, you buy low, you sell high. Buy low, sell high. We've talked about the fundamentals, the investment and the industrial demand. We've talked about the real yields, and now this. What's interesting, this has just come out, the miners to gold ratio looks to be breaking out. And from what much smarter people than me that have been in this game for 50 years constantly say that it's actually the miners that lead and the metals, the underlying metals, follow. That it's not the other way around, which I once thought it was. It's actually the miners that lead and the underlying metal follows. So this is one to keep an eye on. One to keep an eye on. You can no longer buy commodities at Merrill Lynch. My guess is many analysts and even executives are too young to know how profitable a hot commodities market can be. They will soon. Jim Rogers. Now, I've shared this also in a previous video. Palladium. Now, palladium ran from $500 up to $2,500. So a massive return. But that didn't happen in a week. It didn't happen in a month. It didn't even happen in a year. This took more than 2 years to come. I bought silver in 2008, 2009, sold it in 2011. More than 2 years I held that for the price of silver to run. And the same thing with palladium. When they have their run, they don't go straight up. And if you look at that graph, you can see that many times on that way up, it pulled down. So once again, patience, understanding the fundamentals. I'm happy to sit here and own silver. Silver being manipulated down is an opportunity. It's an opportunity to buy more, to accumulate more, because long term, over the coming years, silver's not going to be this price. Absolutely no way, not when you look at the fundamentals. When you look at where we're going, where inflation is going to break out, what central banks are going to do with capping yields, the industrial demand. I'm patient. I've rode this. I've ridden this rodeo before. The question is, are you patient enough? So this is a long-term chart of the gold-silver ratio. The gold-silver ratio as of the date of this recording is right on 70, 69.7, something like that. 80 is usually high. Only twice has it hit 100, including last March. 80 is usually high. So we're at 70. So we're still relatively high. And as I've mentioned in previous video, Keith Neumeyer has said that for every 1 ounce of gold that they mine, they're mining 8 ounces of silver. So the actual mining ratio of gold to silver is 8-1. It's 8-1. Now, am I saying that the gold-silver ratio is going to go to 8-1? No, I'm not. Could it? Maybe. I don't know. All I know at 70-1, it's going much lower, which means, to me, silver is going much higher from here. This was interesting. An article back in 1920. Silver was actually at a ratio of 1-1 for this period of time. For the first time in history, a silver coin of the leading nations of Europe sold at a higher price than gold coin. Am I saying that the gold-silver ratio is going to 1-1? No, I'm not. No, I'm not. But markets get things wrong. And markets can go to one extreme and to the other. And so at 70-1, I think silver is undervalued from that point of view. Buy low and sell high. It's pretty simple. The problem is knowing what's low and what's high. I think that's great investment advice from Jim Rogers. Now for me, I think silver is cheap. I've shared in this video fundamentals, macroeconomic reasons, using history to, I guess, share what my thoughts that silver is still undervalued, severely undervalued. It's 50% off its all-time high. What other asset class is 50% off its all-time high? The only thing that I can think of is sugar. But we know about the health benefits with sugar. People have become more educated. People are moving away from sugar, going to more healthy options. But silver, being 50% off its all-time high, the demand for silver from an industrial and an investment sense is only going up while supply is peaked and supply goes down. So I think silver is severely undervalued. How high can it go? I don't know. At what time period do I have? Don't know. I've held silver before for 2 to 3 years. I've been buying silver again for about 18 months now. Been accumulating, still accumulating it. I'm happy to be patient. I'm happy to wait. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. If you haven't hit the like button, please do so. Subscribe, hit the notification bell, and take care, everyone. I'll see you again on another episode of Finance Uncut.